Everybody, Brian here, quantlabs.net. Welcome to this analytics tutorial for the service. A couple of things I want to highlight here is you want to measure the condition of where the cryptocurrency market's at as an asset class in terms of is there enough momentum to drive up prices. What I can say is when you go into something like coin market cap and you look at all of these different coins in coin market cap by volume, by price change over a certain period of time, what you'll notice is when Bitcoin goes up, certain coins will go up, and there's other ones that will not. They'll go the opposite direction or won't even be affected by the price of Bitcoin. There's a couple of coins in there that are not related around Bitcoin performance. Litecoin's one of them. So what I want to show you is how I measure this quote-unquote risk. So the first thing is in a folder that you can download and it gets updated every hour. I measure 4 coins, and they're usually in the top 10. These are in the olden days were the 4 largest, but they're still in the top 10. You got Bitcoin, Ethereum, Bitcoin Cash, EOS, let me start again. Bitcoin, Ethereum, Bitcoin Cash, and Litecoin. So there's only 4. And they're fairly consistent. I mean, I could change these up down the line, but they're just a good pulse of where the overall crypto space is at that time. So there's a couple of files that will help you out in this Word document called Crypto Risk. So we have here the latest price change over a certain number of hours for Bitcoin USD, Bitcoin Cash USD, and they're related around each other. Litecoin can be independent of all 4 of these, so you have Litecoin against USD and Ethereum Classic USD. This one for sure now contradicts the performance of Bitcoin, and then we have Ethereum as well. So out of that, what you can say is how many of them, based upon the average price move of these, however many it might be, 100 or whatever, and these are measured for the last hour. So you can get a general pulse of how things are moving. So in this case, you have the risk direction where 4 out of the 5 are between 0.5% and 1% moves. So those are not strong, but anything over 0.5% is pretty good. We have the anemic between 0 and 5 or 0.5%, and then we have the negative movers. So when you have a bunch of these pairs over 1% moves on average, that tells you you're in a very strong momentum-based asset class or market condition, which means you're going to want to trade now and trade as many as you can to get high probability of profit on those positions while the market direction in the crypto space allows. Then you get into, you're doing all right. You'll still get some profit, not as crazy as if it was aggressive. And then we get into the anemic where you might get a few positions that are profitable and not. So what you're saying is, and you have no control over this, is you want to be trading really when the market allows, when you have a percentage of those coins and those pairs that are moving over 1% on average over a period of time, because now you can make money in those conditions. So understand this really well. Another file that's really helpful is this log called risk on log. Now, over the couple of years I've been doing this, what I've noticed is this risk on log is what we call a weighted average of the price moves of these 5 pairs. Okay. Also, you also factor in the price moves, but also the volume. So obviously the big fish will be Bitcoin. Okay. So these smaller coins, again, purposely will not have much of an impact based upon the performance and the market direction of Bitcoin. But mind you, you could get, let's say, Litecoin or Ethereum Classic like we had 2 weeks ago, where Ethereum Classic was moving 10%. So even though it's a tiny volume, it could still skew that weighted average. If either, let's say, Litecoin or Ethereum Classic are moving uh, very quickly, even though Bitcoin and the other ones are not, or you get Bitcoin Cash outperforming Bitcoin. There's a whole slew of this. So you get a weighted average of how these coins are moving. So when you watch this, you can, and this is the only asset class that I know of that you can do this kind of measurement. You can't do it with forex. You can't do it with stocks. Maybe you can do it with stocks somewhat with the indices, but when you watch the nuance of this risk log over time, you can see where it's negative, and as this weighted average here starts to build every hour and you log it, you can start to see, and over time you'll get to know the pattern of when to really start trading so that you can get a higher probability of profit once all 5 of those pairs are moving on average above 1, okay, or even 4 out of 5 or 3 out of 5. So that's really important to know. So another question people come up and say, why am I not doing, let's say, Bitcoin Cash against Bitcoin or Ethereum against Bitcoin? Why are you using a fiat currency like a USD? The reason I use USD because it's a lot more stable in the price. So the price moves will be much, much more stable than versus a volatile crypto like Ethereum or Bitcoin. So if you're dealing with a USD, you can get better performance when the pair moves, and you're using, in my case, I use momentum-based strategies. And we'll call them a God told me where the light went on. When you, in the world of crypto, are trading in a very volatile trading environment, you have 2 options. You have your momentum-based strategies and you have your mean reversion strategies. So on average, mean reversion strategies will do better when it's crypto against crypto, meaning Ethereum against Bitcoin or Bitcoin Cash against Bitcoin, because it's crypto against the crypto as a base currency, or the stable coin as they like to call them. So a mean reversion strategy like a VWAP will perform better in a crypto against crypto environment, as opposed to a momentum based, because you're limiting a lot of the volatility on the price and the price moves when the momentum strategy is crypto against the fiat currency like USD. That's why you get, when I look at the motor wave, you will see certain pairs outperform when there's a crypto against a fiat currency, be it Euro, USD, Japanese yen, or British pound. That can happen from time to time, even though that same crypto against Bitcoin or that same crypto coin against Ethereum will not get the same performance, and that's why. And it may be because of momentum-based strategies or mean reversion strategies will perform better when it's crypto against crypto versus a momentum-based strategy when it's a crypto coin against a fiat. So what I expect to say here is if you're using a momentum-based strategy like I do, crypto against crypto, you'll get lower performance, whereas opposed to take the crypto against the fiat, namely US dollar, with a momentum strategy, you'll do better. Usually have a higher probability of getting better performance with your strategy. Whereas opposed to you are using a mean reversion strategy, like as I said, VWAP against against crypto, you'll get better performance with a mean reverting against crypto strategies or coin pairs. So that's essentially, and this is really important to understand that. This is why I like crypto, because you get better moves. It can be more predictable based upon these patterns I'm telling you and based upon what I'm seeing. But this little risk on thing is really helpful to know when to allow your strategy or bot to perform better in those market conditions when you have more pairs than the 5 big ones, as I call them, moving in that direction where they're moving higher chances of it being over 1%. So take this as heed. with these type of metrics because they will help you get better performance based upon what types of bots you're using. So alone, this metric with a risk on and the weighted average that I'm speaking about here, and this risk on log, can be really helpful. And as I said, you can historically watch when the market's gonna start to take off based upon just one metric, especially when you start to see these big fives sort of with a weighted average price based on volume. They seem to oscillate over time when it's low. This volume weighted average price is low, and then at the other end, you know when it's about to start to take off because they do oscillate. The width of the swings are different, but you'll see it as you watch this risk on log. So might not be a big thing to watch here, but it has a huge impact on your overall trading when you watch this one little average. And as I said, it's the only metric that I know of that's predictable and can help you get better performance with your bots. Hopefully it'll help you out. Talk to you later.